Hello and welcome back to Money Talks, your guide to the Canadian securities. I'm your host, Rita. It's so great to have you with us again. A huge thank you to our incredible listeners for all the support. And if you're new here, please consider hitting that subscribe button, leaving a comment, or sharing the episode with a friend. It genuinely helps us create valuable content to boost financial education here in Canada. Last episode, we covered the structures and regulations of mutual funds. If you missed it, I highly recommend going back for a listen as it sets the stage perfectly for today's topic. Today, we're diving deeper, and to help us navigate these waters, we have our expert guest back with us. Hey, Jonathan, welcome to the show once again. How's everything going in the market?
Hi, Rita. Thanks for having me back. The market is doing what it does best, keeping us on our toes. But it's a great reminder that understanding the fundamentals is more important than ever.
Exactly, and that's a perfect segue. Today, let's talk about the importance of understanding mutual fund types and their features. For someone just starting, the sheer number of options can feel overwhelming. Where do we begin?
That's the key question. The best way to start is by understanding that mutual funds are like a toolkit. There's a specific tool for every job. The Canadian Investment Funds Standards Committee, or CIFC, groups them into categories based on what they invest in. Think of it as organizing the tools in your toolbox. The first and most cautious tool is the money market fund. Imagine you have some cash you want to keep safe and accessible, but you want it to earn a little more than it would in a standard savings account. These funds invest in very safe, short-term debt, like treasury bills and high-quality corporate paper. They're the least risky type of mutual fund.
So it's like a parking spot for your money. Super safe, but probably not going to make you rich, right?
Precisely, it's for liquidity and safety of principal, not for growth. The main risk, though small, is interest rate risk. A rapid rise in rates can affect its value. Next up on the risk ladder, you have fixed income funds, also known as bond funds.
Okay, so we've left the parking spot. Where are we now?
Now you're looking for a steady stream of income, like collecting rent. Bond funds invest in government and corporate bonds. They're designed to provide regular interest payments and are generally safer than stocks. The main risk here is also interest rate volatility. When interest rates go up, the value of existing bonds tends to go down.
That makes sense. So we have a safe option and an income option. What if someone wants a bit of both, a little bit of an all-in-one solution?
That's where balanced funds come in. Think of them as the combo meal of the investment world. They invest in a mix of stocks and bonds to provide both income and the potential for capital growth. The fund manager will adjust that mix, say 60% stocks and 40% bonds, based on their market outlook. It's a great middle ground for investors who want diversification without having to buy multiple funds.
That sounds like a great starting point for many people. But what if you're younger, have a longer time horizon, and you're really chasing that long-term growth?
Then you're ready for the growth engine of the portfolio, equity funds. These funds invest at least 90% of their assets in stocks or equities. Their main goal is long-term capital growth. Imagine you're planting a forest. Some trees will be sturdy blue chips, like the big Canadian banks, while others might be smaller, faster-growing saplings, what we call small or mid-cap companies. Equity funds are more volatile and carry more market risk, but they also offer the highest potential for long-term returns.
And within equity funds, there are even more options, like focusing on companies that pay dividends.
Exactly. Dividend funds, for instance, focus on high-quality companies with a history of paying dividends. Here in Canada, that income gets favorable tax treatment through the dividend tax credit, which is a nice bonus. Then you have specialty funds, which are highly concentrated. They might focus on a single industry, like technology or healthcare, or a specific geographic region. These carry more concentration risk because you're not broadly diversified.
Jonathan, this is a fantastic breakdown. It's making a complex topic so much clearer. Listeners, if you're finding this as valuable as I am, please take a moment to subscribe and share this episode with a friend. It really helps us bring you more of this content. You can find Money Talks on Spotify, Apple Podcasts, YouTube, Podbean, Audible, and wherever else you get your podcasts. Okay, Jonathan, before we wrap up, there's one more type I want to touch on that seems really popular for retirement planning: target date funds.
Yes, these are brilliant for people who prefer a set-it-and-forget-it approach. A target date fund is designed around a specific goal, usually retirement. Let's say you plan to retire in 2050. You'd buy a 2050 target date fund. Early on, the fund will be aggressive with a lot of equities to maximize growth. But as you get closer to 2050, it automatically and gradually shifts to be more conservative, moving into more fixed income and money market assets. It follows a glide path to reduce risk as your target date approaches, all without you having to do a thing.
That's incredibly convenient. So we've covered the what, the different fund types. Now let's quickly touch on the how. How are these funds actually managed? I hear the terms active and passive thrown around all the time.
It's a fundamental difference in philosophy. Passive management or indexing is when a fund doesn't try to beat the market, it tries to be the market. An index fund, for example, will simply buy the stocks that make up a major index, like the S&P/TSX Composite Index, in the same proportions. The goal is to match the index's performance. Because you're not paying for extensive research or a star manager's picks, the management fees are typically much lower.
So you're not trying to be a hero, just getting the market's average return at a low cost. What's the alternative?
The alternative is active management. Here, the fund manager and their team are actively trying to outperform the market benchmark. They conduct in-depth research to select individual companies or shift sector weightings, believing their expertise can generate superior returns. You pay a higher management fee for that active effort and expertise.
So it's a trade-off. Pay more for a chance to beat the market, or pay less to simply match it.
That's the core of it. And it's a huge debate in the investment world. Many studies show that over the long term, very few active managers consistently outperform their benchmark index after fees are factored in. But a great active manager can certainly add value. It really comes down to an investor's personal philosophy and cost sensitivity. This has been incredibly insightful, Jonathan. So to recap for our listeners, there is a mutual fund for almost every financial goal and risk level, from the safety of money market funds to the growth potential of equity funds and even automated target date funds. And understanding whether a fund is managed passively or actively is key to understanding its strategy and cost. Any final thought for our listeners trying to make sense of all these options? My biggest piece of advice is this: match the fund to your personal goals, your timeline, and your comfort with risk. Don't just chase last year's top-performing fund. The best investment is one that is part of a well-thought-out plan and lets you sleep soundly at night. Perfect advice to end on. Jonathan Cartier, thank you so much for breaking all of this down for us today.
It was my pleasure, Rita. Always happy to be here.
And a huge thank you to our listeners for tuning in. Next week, we're going to discuss what happens when you decide to sell your mutual funds, covering withdrawal plans and the all-important tax consequences. You won't want to miss it. Until then, this is Money Talks, your guide to the Canadian securities.